Good afternoon, everyone. It's Dr. K coming at you from somewhere in the world. The sun's out in the northern hemisphere for much of that and enjoying the summer. Gil is, of course, well ensconced in Playa del Rey, although not for long. I guess he's going to be moving up the coastline this weekend to sunny Santa Barbara. At any rate, the markets are perhaps not as sunny as they could be. We've got a buy signal on the model as of 2 days ago, and then the market promptly sold off. It's nervous because, of course, there's more talk about easing up on quantitative easing from the Fed. But as we said in this morning's missive, the QE is here to stay as long as the economy continues to be weak. Europe and the UK are well into their recessions. There's not a whole lot of sign of recovery on this side of the pond. And as we all know, these economies are quite well connected, very deeply connected. Even in the 20th century, in the 19th century as well, world economies were quite well connected. But I'd say that even more so today, that's true. And therefore, as long as things remain pretty bad over here, I don't see a whole lot of chance that the U.S. is just going to all of a sudden get up and running. A lot of the economic reports that have come out have been massaged. And the recovery in the U.S. Still seems fairly anemic, and therefore I think the Fed's hands are tied to keep QE on full as much as they don't want to. I don't think they have a whole lot of choice in the matter. And as we know, with QE 1 and 2, the markets had a more or less a good uptrend. QE 1 marked the beginning of the current bull market, and one could argue that the bull market's getting old, long in its tooth, but again, these are unprecedented times, and as long as quantitative easing remains on full, and this is true with central banks around the world, the odds are greater than not that the uptrend will probably continue in some form. Maybe not as sharp an uptrend as we saw with QE1 and QE2, but we have seen that so far this year we have had an uptrend of some form. In the first quarter, the uptrend was pretty weak, but it was still an uptrend, and then that uptrend started to take off from mid-April to mid-May, and it was in mid-May that there was talk that Bernanke came forward and said they might have to slow down the pace of quantitative easing, and the market's been in a sideways trend ever since. Based on price volume action of major averages and leading stocks, this back and forth could continue for some time. The model is on a buy signal simply because the odds are tilting toward the market resuming its uptrend sooner than later. So we'll have to watch and see. Precious metals, of course, they're getting hit pretty hard because they're probably the most sensitive to talk about QE being slowed, and they have been in downtrends for a good part of I'd say about, for silver and gold. I mean, because silver hit its peak in mid-2011. So this sideways to down silver market has been in place for 2 years now. And for gold, one could argue that it was sideways and then really started on its downtrend in the fourth quarter of 2012. So we got 3 quarters of downtrend in gold. And that could be that, there's a lot of cross currents in these precious metals, so it's difficult to say if there's any one factor that's contributing to this downtrend. And I'd rather not actually even speculate on it because of the numerous cross currents going on with these precious metals. It's best to just focus on the price volume action and just know that there are downtrends. And right now there's really not a whole lot to do in either of the metals. Gil?
No, nothing to do in the metals at all. So not like we've been interested in them at all as we've been correcting, and it looks like they're going to need to. I'll tell you guys what I'm looking at here. Some of these shorts I noticed, like I came in short, Apple from yesterday, so just kind of threw that out. And you notice you're undercutting this low here, so I actually covered that position, and I'm sitting on a pile of buying power right now, trying to decide whether I want to come in on the long side heavy here and try and play a bounce, because I think as the market comes down, obviously everybody's getting their panties in a bunch here, and you're seeing the NASDAQ is coming right to the 50-day. So I'm trying to keep my head here and be opportunistic. There have been some good shorts that we've played previously, and we've talked about them on the webinars here. And some of these have actually worked pretty well. We have the Apple for one, and let's see, CRM was another one, and that one's. Notice though it hasn't really broken down through these lows, so it's still kind of hovering around here. And we'll just have to see how some of these play out. I was looking at CF yesterday. We talked about that. It came up through the 50-day. Now it's rolling back through. I guess if you wanted to, you could try and short it here. Not necessarily clear to me that you'd have. I don't know. I mean, I think you could get to this low if the market continues getting weak, so that's a possibility. But we can run through some questions on shorts. The only issue I have right now with trying to short the market is, let's see, did I go in? Yeah, I did. Is whether you're going to get a bounce right here off the 50-day on the NASDAQ. And if that happens, you don't want to be shorting now. I think if you had a couple of shorts coming into today, you're making some money, but it looks like you could be getting to a spot where there's at least a bounce. So I'd be careful there. I wouldn't be trying to short the market willy-nilly, okay? But that said, the action looks pretty poor right now. You're trading pretty heavy volume, so you're up. I think it's like 84% increase on the Nasdaq right now, and 39, almost 40 on the Nasdaq rather, and 84% increase on the NYSE. Let me correct that. So looking pretty ugly as far as the price volume action. So you're wondering, are we going to move a little lower, perhaps undercut this low on the NASDAQ? That's a possibility. You seem like you have a lot of velocity. So I think you got to be careful. Watch your stocks. And if you hit your stops, your trailing stops, then just blow out of your positions. Otherwise, Dr. K is suggesting that you might just be in this market where, okay, yesterday Bernanke made his comments and the market didn't like that. Obviously, and even though it was swinging around quite a bit, it almost looked like we were going to turn back to the upside as he was going through his interview. But I think for the most part, they're talking about a set plan to withdraw from QE. But my feeling is that they're not going to be able to because the economy just is not strong enough. And I think the idea that it is pretty well mythical at this point, and much of the data is simply being massaged by the government number crunchers to make it look better than it is. I mean, we started to see some stumbling in housing, and you've seen some of the names there really getting slaughtered. Lennar, for example, just blowing apart today. Some of the other ones that were acting better. Lennar is the weakest one in my view. Here you have DHI breaking down through its 200-day moving average. So, to me, housing is weak, and I think the housing stocks are showing that. And so that's one area of concern that exists as far as this market goes, and I think that's that's not an area you want to try and buy into, and I don't think it's an area of strength. So, anyways, let's see what else do I see. I'm just looking at some of these names. I'm watching Tesla. Have a little bit of it. Is bought around 100 and change, and so we're just watching this one coming in, wondering if it's going to hold up. Stock was trying to go higher earlier. But it's possible if the market continues lower, it's not going to hold up. So InvenSense, another one we've been watching, pulling back to the 10-day moving average this morning, trading in the upper part of the range. Not really that volatile. Other names that have looked decent recently, you got Cree on a pocket pivot breakout. It's pulling right back to the 10-day and the top of the prior base. So hard to say this thing's necessarily in trouble. Well, there are other stocks that are getting hit worse. Some of the stocks that have acted well over the last few days, like you look at this Infoblox, this thing's actually up on the day again, and it was up big yesterday, which I thought was very interesting. Even Angie's List, which is kind of a sleeper, has had a nice move after this pocket pivot here, and now you're trying to come back up off of the 10-day moving average today. And so, some of these things, not everything is looking all that ugly, but for the most part, you've got. Let's see, let's go through this buy list of mine that's down here. Pretty much everything here. Let's see, Workday, trying to come up off the lows of this base here. You had a breakout and a pullback. It seems kind of typical for this stock. Notice that's up today. What else is up? This Viasat is a little thin stock. These guys still have advanced satellite internet, I believe, and I think the most advanced system out there. This stock is actually holding up in a tight flag formation, and today bounced off the 20-day moving average. So those are probably the only things holding up. But I think you got to take it stock by stock and just be a little bit careful. I'm not sure I'd go plunging in on the short side here. I'm actually looking to cover any shorts as we pull back. And like I said, with the NASDAQ at the 50-day in this zone, maybe even undercutting this low, you're starting to get a little bit long in the tooth on the short side. So it's a pretty brutal gap down, and it might imply more downside. So I think it's something that you have to keep an eye on. So that's basically where we're at. So yeah, I'm just kind of sitting here with a lot of buying power, seeing what I want to do in terms of either stepping in and buying or blowing out whatever small positions I have left. So that's basically my view right now. And I'd be careful here because I think this downside is getting a little obvious here. You get a snapback rally. Somebody asked a question, Dr. K. You ready for this one?
Yeah.
IBD's recent change from marketing correction to confirmed uptrend surprised me. Gil even appeared skeptical. Yeah, I was a little skeptical at the time that they called that S&P 500 move, which was back here on this day, a follow-through day. I mean, it seemed a little dicey to me, but I guess you could call it a follow-through day, but that's failed now. So that maybe they're going to go back. I'm going to guess they'll go back to market under pressure here, and that'll be their call probably overnight. But somebody's asking this question: in your analysis, does the longer the market bases before a follow-through day appears increase its validity? My short answer to that is no. I mean, I don't know what you're talking about really. Here's your low, 1, 2, 3, 4, 6-day follow-through. So there you have a 6-day follow-through. Not sure what you mean about the market basing, because it wasn't. It was in a downtrend, and then you bounce, and now you got a rally here. So Dr. K, what's your take on that? Does the longer the market bases before a follow-through day appears increase its validity?
Well, it depends on the quality of the base. I guess is my short answer. In other words, if it starts to get real quiet and tight, just like a stock, and then breaks out of that, the odds are greater that that breakout will work. But in the markets that we've seen in the last few years, you don't really get that kind of action. It's pretty rare that you're going to see a market go sideways and then you have a breakout. It's not like the 70s where you did have that kind of action. Things are more volatile in general these days. I mean, a good example is the follow-through day requirement. The threshold level for my model in the 70s was just 1%. That's all that was required. We haven't had that 1% rule in effect for many years. It's simply because the markets are more volatile since the year 2000 than they've ever been. And that's on average. The volatility has just crept up higher and higher. So we have threshold levels typically that are 1.3%, 1.5%. Those are not atypical threshold levels. So it comes down to price volume, quality of price volume action when the market is going sideways. In other words, if it's going sideways in a volatile, sloppy way, that's not very constructive at all. And any kind of follow-through day that happens off that kind of formation is probably more suspect. But then you can also use the action of the leaders to guide you in terms of the quality of that follow-through day. And same with the breakdowns. If you have a sideways and it's a very volatile sideways move, the breakdown is to not be trusted unless it's accompanied by breakdown in leadership as well.
Yeah, I mean, from my perspective, a follow-through day is a follow-through day. I don't really worry about whether the market's been basing for a while before. I mean, to me, that would imply that the market had been in a downtrend. It was simply moving sideways while still in a downtrend without having a follow-through day in between. So it seems like a situation you probably wouldn't see. And like Dr. K was saying, it's kind of rare. That's not really what you see. Anyway, someone's asking, is the market direction model close to changing, Dr. K? Or are you hanging?
Well, as you know, the model is well aware of QE, so it's going to give the market a little bit more play here. Not a whole lot. I mean, it doesn't take much for the model to go back to cash or to a sell signal, especially if we start. The Nasdaq's sitting on its 50-day, and you've got the S&P that's just undercutting it, and basically, if the selling pressure increases rather than stabilizes, then the model would most likely not be sitting in a buy signal. It's going to be switching. And the degree of selling pressure will determine whether it goes to cash or a sell signal.
Can I ask a question, though? Do you account for like a huge volume gap down, which is what you're seeing today? Is this extremely negative, or does this strike you more as sort of an exhaustion move to the downside?
Well, we've seen this kind of behavior in the past, and often that was where the market found its floor, because QE would just come in and and put that floor in. So that remains. Obviously, we're looking at the model's looking at this sort of action in terms of the market finding a floor, and if it doesn't, if the selling accelerates, and we get a market that closes on its low on high volume too, that's obviously a negative for the overall market tone.
So from here specifically, what would trigger a sell signal? Would it be an undercut, say, of the June 6 lows, or a weak rally, or what combination of factors? Or let's say we close down.
Yeah, it's a combination. Let's say the S&P undercuts the June 6 low, and then the Nasdaq can't hold the 50-day, and we also see leadership deteriorating. I mean, those three factors would be enough to send the model out of its buy signal and into either a cash or a sell signal.
Okay.
Because the market, unfortunately, is in a bit of a jerky cross section, a lot of cross currents going on. So, on the one hand, you want to see positive economic reports, but that means that QE will get withdrawn sooner. On the other hand, if you see negative economic reports, QE then is going to be on full bore. But if the economic reports are quite negative, then that also could shake the market down. So you get this tug of war going on, and that makes for a possible choppy environment, which is very challenging and nearly impossible for trend followers to profit from.
Mm-hmm.
But that remains to be seen. We don't know. When all in the past, when things seem like they're going to go into a very unprofitable period, the market finds its footing and starts on an uptrend. So I don't want to second guess.
Okay. Somebody says Bernanke didn't get it right at the top in 2007. How can he get it right now? I'm not sure I know what that.
Well, I think Bernanke's trying to massage the market into what he wants it to do. He was late to the party in 2007. He's late again, and what he's doing isn't constructive in the long term. But in the short term, that is over the next few months, he could certainly affect another uptrend in the market, which is what he's looking to do. Mm-hmm. And so, QE1 and 2 certainly proved out in that fashion, and QE3 is struggling to prove that out. So we'll have to see.
Okay. Let's see. Any questions about specific stocks? So far, I don't see anything up there, so it seems like everybody's pretty quiet. That must mean that everybody's in cash and hanging out, waiting to see how this sell-off pans out and where do we actually get to a bottom here. Nasdaq's just going through its 50-day moving average, so it's starting to get a little bit scary here. Let's look at the put-call ratios. Let's see. I think you got to look at what are those, Dr. K? Do you know what the symbols are for those? I think you're getting up pretty high, like 1.5. 1.5. What are the symbols on the put call ratios?
Dollar PCCE
Is that it?
-ST.
Yeah. So you spiked out at 1.8 earlier on the equity CBOE, and then the other one is it PCX? Whoops.
It's dollar. There's another one. Dollar PC -ST. Just dollar PC -ST.
Big spike in here as well, and so. So there's a fair bit of fear in here. So this is kind of going to be interesting to see how this pans out. I think if it starts to get worse, then I don't think you have much choice but to raise cash. So I think it's just a matter of watching your stocks, assuming you're heavily long. OVTI, this is a stock we were talking about in the chat room, and you had a viable gap up. Let's pull up the weekly chart. It doesn't show up on the weekly chart mainly because weekly charts don't show gap ups. It makes the action look like it's smooth. But you can see you had a viable gap up. The stocks ran up. Looked like it was breaking out yesterday. Sort of like a pocket pivot breakout through the top of this range. And that's coming in with the market. So really, most stocks right now, it's a market question. And I think it's just a matter of where they come back and test support, if they blow apart or what. Just running through my list, I'm looking at ACAD. This is holding up in a flag, pulling back. Just trying to go sideways right now. Some of these other big leaders like Ambarella, I don't know if I call it a big leader, pulling back to the 10-day moving average. We've looked at Angie. This is one I've been keeping an eye on. Started to get moving yesterday. You got a gap down here, still holding the 50-day moving average, you might notice. Let's see, Biogen I think is done because we saw that gap last week. It gapped, or rather, gap down and broke down through the 50-day moving average, you rally back up into it, which makes complete sense, and now you violated it. So it looks like, for the most part, some of these biotechs are in trouble. I've been talking about Celgene as a short on rallies up into the 50-day moving average here up around 121 and change, and you can see here that the stock did run into resistance on money. It's rolling over. Volume is, I don't think it's that heavy this morning. Let's take a look. It's 19% above average. So again, you're not seeing this massive selling in it right now. I think you have a lot of buyers on strike and they're pushing things down. But if this undercuts the low here, that would be my downside target, 111.50. So that's what I'd be watching for on that one.
By the way, I wanted to just mention real quick here on that put call. In the last, well, basically in the last 2 years, we've got, well, basically since October, we've got the put call that went above that 1.8 level. Where, I mean, in other words, it's spiked. And then what happens is the market either, that's the day the market finds its floor, or, well, in every case, the market bounced after this kind of spike, first of all. But the question is, in 2 of the cases, the market bounced and continued higher. In one case, the market bounced over the next few days and then undercut that low by just a couple days and then found its floor. So it's tricky because, I mean, obviously if we bounce for a few days and then we undercut today's low, that means the NASDAQ is breaking down through its 50-day, the S&P is already under its 50-day, and leadership will probably get sold out pretty hard because I think the whole market's going to see that as a pretty bad sign. Mm-hmm. But that would be possibly similar to what we saw June 4th of 2012. First of all, we had May 18th of 2012 where we had a spike in the put-call ratio on the 18th. That's the 18th of May. And you'll see on the NASDAQ, the market had been in a downtrend for almost 2 months. Then it bounced over the next week and a half, then rolled over again and undercut that, then found its floor. So naturally, if we were to bounce and then undercut today's low, I don't see the model's most likely not going to stay in a buy signal because we don't know that it's going to just find its floor shortly after undercutting. So it's best to be on the cautious side. The model will always opt for the cautious side rather than to give the market too much room. That would, in the model's view, would be way too much room, and it would go to cash or probably a sell signal at that point. Okay.
Somebody asked, Dr. K, what was the economic catalyst in your view that set the stage for the yearly 100% returns you made in the 90s? Creation of internet company, and what do you see as a necessary economic backdrop for a future stock market in which trenders can make real money? Let me interject here and tell you that I think it's pretty simple in my view, what happened in the 90s. You were in a secular bull market that had started in the early 80s. You had pretty much lower interest rates, and you also were benefiting from a secular move by the investing public out of, or rather into equities. But around 1990-91, the investing public was underinvested in equities, and so there was a secular shift back into equities, and you had baby boomers as well becoming a bigger force and investing for their retirement, and so that was another factor that increased money flows into the stock market. You also had accommodating monetary policy, and also you had the internet starting in the advent of the dissemination of PCs and making them more affordable for the average consumer. So there were a number of catalysts. I mean, I think it's kind of intuitive if you were paying attention during the 1990s what was going on and what drove the bull market. I think you need to see something like this going forward to see another big bull market, but it doesn't mean that you can't make money in individual names. There are always stocks like Tesla's or LinkedIn's or 3D Systems, the Stratasys. Notice this one's up today. And so there's always those catalysts existing in every environment. They may be broad or they may be narrow depending on the fertility of the actual environment. I think the 90s, obviously a parabolic move in the market, pretty obviously a time when everything was hitting on all cylinders. Dr. K, you got anything to add to that, or did I cover it?
Well, you pretty much covered it. I mean, I like how it was almost like a handoff when you in a relay race, and runner hands the baton to the next one. So basically, the champion handoff was the market in '95. It had that huge bull market, I think it was the best bull market that Nasdaq's ever had. And then you had the onset of Netscape. I think that was the first internet IPO. And that was in 1996. That was early '96. And that led to, of course, a plethora of internet IPOs that just accelerated, and also accelerated the interest in the stock market to the point where, as the saying goes, when your taxi driver is giving you stock recommendations, it's time to sell. And we certainly saw those signs from '98 into '99. When I remember a lot of people were quitting their jobs just to day trade at home, thinking that they figured out the market, so they don't have to work anymore. So and that was a classic bubble behavior. I've studied bubble behaviors going all the way back, South Sea bubble, the tulip craze, all these great bubbles, and the patterns are always the same. I'm fascinated by the chart patterns, and when a bubble expands and bursts, and you get decimation everywhere, and it's fascinating to see, how it evolves into that situation. And so clearly, the market found that bubble right into the March 2000 market top. And yeah, so we had all these great catalysts in the '90s that helped create that situation. And I think for us to get into that situation again, I don't see all those catalysts lining up again, but we could certainly get a different type of catalyst in the name of all this money creation and inflation that starts to run rampant, that becomes difficult to control, and where currencies start to really devalue because there's been too much money in the system. But again, central banks, I think, are very cautious about that. So, and these are big countries, United States, the European countries, and the UK. So it's not like a Yugoslavia where you have or Zimbabwe where you have a tiny little country which can control money flow and have hyperinflation set in so quickly. I think it's a different scenario here, and so at best, unfortunately, we might get a lot of stagflation in the offing in the years to come.
Somebody points out Barron's recently had a dancing bull on the cover with Dow 16,000, I guess, on the headline. I don't know. Barron's is perennially, wrong way. So maybe that was the sign of a market top. I mean, they had that article on Tesla and babbling about how that was it for Tesla because it was just a short covering rally, and of course, the fact that you could now borrow Tesla stock was much easier and the rate was lower. That was obviously a sign of the top in the stock, but it's stubborn. It's still holding up above 100 even as we speak in the midst of this brutal market sell-up the last couple of days. And I would say, hey, if it's so weak and the market's getting hammered, I mean, this thing should be down $20, right? But it's not. It's hanging in there. So I think that's intriguing. And I got to admit, Tesla's stock that I remain fascinated with and keeping my eyes on it here as in terms of looking for a potential buy point if the market's able to find its feet and turn, which is a possibility. I'm not, you're watching the market try to come off the lows. Things got pretty ugly earlier. I'm watching my handy-dandy 620 chart here. Let's pull this up. Let's throw the market on here, see what's going on here. Yeah, you're kind of bouncing along the lows. You might be in a position to turn. So my guess is if you do turn, it's going to be pretty furious, as most of these turns have in the age of QE. And so if you're short, be looking for places to cover. You can also be using the 620 chart to guide you in terms of covering. I know Apple this morning was pretty quick, even pre-open. It was down here, and I'm watching this and decided to cover before we even get opened up here. Now it's kind of breaking down again, so maybe this thing is headed lower. So that's a possibility. I do think Apple is going to. I think eventually it's going lower. So to me, it's just a matter: do we undercut this low and then bounce into the 50 one more time, or are we headed for this low? And I think that's all a matter of where the market goes. So if the market starts to break down, I think this thing might have some issues, and I think it remains one of my favorite short sale targets. Somebody asking about Kihu. Kihu has been acting pretty well. it had a pocket pivot coming out of here, but now you're right back to the top here. So not like it's not like it's off to the races here, but it's had a pretty good move. So it's acting okay. And I think in most cases you got to watch stocks. If they have an area of support, if they just broke out and they're pulling back in, you kind of have to decide. Are you going to pull the trigger on them or see if they bounce off of their lows and bounce out? Somebody's asked, what would be another entry point for Tesla? Well, my thinking is, we were looking at this yesterday. For anybody, whoops, there's my dyslexia coming into play again. We were watching it this day in the chat room, and we're noticing the volume almost got there. Almost, I think you ended up with on the day 8.797. You needed to beat this day, which was 9.231. So just barely missed. So I think as you're coming down towards the 10-day, which is now 100 and change, you might be watching for some sort of pocket pivot move off of the 10-day, which might occur. Supposedly there's some event today. They're going to be announcing something. I'm not sure what that is, but I guess some interchangeable battery. But that's kind of what I'm looking for. Somebody asked a good question, I think. Could the U.S.'s increased oil and natural gas production be a catalyst for growth going forward? I've often thought that if the U.S. is going to pull itself out of the morass that it's gotten itself into, in terms of all this debt, one way to do it is by becoming less an importer of oil and more an exporter of energy, which it's starting to become, and they're projecting that that's going to happen, I think, over the next several years. And so on that basis, I think there is potential for the oil industry, like it did in the 70s. I think Bill O'Neill made a lot of money in some Canadian oils back in the 70s when some oil stocks were having some pretty big moves. I think Houston Oil was one of them. I'm trying to remember what the other one was that he played at the time, but he made a lot of money back then. So that's potential for that. That's one of the reasons why I've kept my eyes on this Bonanza Creek, and I think the fracking plays, they're still basing out, and so definitely you want to keep these stocks on your watch list. I mean, this doesn't look so great today, but you're just forming this base. You could eventually come out of this thing. So I wouldn't, I wouldn't count them out just yet in terms of being potential leaders in another bull market. But that again might take some time, and so that may not happen, right away. But I think that's definitely a possibility, and it's something to keep an eye on as an area of potential leadership, as well as an area where you could see, the U.S. drive an economic boom based on energy. That's a possibility, and so I think that's definitely something that we should be keeping our eye on. So, anyways, let's see. Any more names here people want to talk about? I don't know. I feel like going through my list. I mean, some of the names I think are interesting. This PRLB. What a nutty stock, straight up, coming back in, but that's not like it's the end of the world. I'm watching LinkedIn here, pulling back. I thought it would pull back into the 175 area. It's doing that now. Who knows where it'll close, but we'll see. You have the pocket pivot, so you have this one here and this one here. This one stalled a little bit, so it's not really clear to me whether this needs a little bit more time. Maybe it just hangs out into earnings. Let's see. Going down my list here. Who has some favorite stocks that they're watching right now? VRX. Stock had a pocket pivot. I think it's a market question. I'd watch for it to hold support here at the 20-day moving average if the market doesn't blow apart, and that's kind of where it's pulling right now. But I think you got to kind of lay back on these and watch what's going on. I talked about InventSense. It's just kind of holding in a flag, still holding the viable gap up move in the 10-day moving average. So just kind of hanging out. Nothing really huge in terms of price movements on the charts, and given, like I said, given where the indexes are right now, I'm kind of watching this a little bit cautiously, not wanting to be come in and be a pig on the short side, and looking at some of these names as they're coming in and wondering if they're going to be viable on the turn, if there's a turn here. And if you notice, that's been the best way to make money in this market, is trying to pick up stocks coming into logical areas of support when it's coming in, and adhering to short covering points, when they occur in stocks, and not getting carried away on the short side. In other words, if the market's giving it to you, you want to take it. Triple D is coming down to the 10-day moving average. Let's see. Whoops. What do we got here? This is something's not right here. I think I got my charts messed up here. Yep. Give me a second here. I'm going to try and get things squared up. I believe this is weekly here. Okay. There we go. And this is the NASDAQ. Now we're starting to see some lift here off the lows. We'll see if this carries through. Okay, let me get these straightened out here. Whoops. Okay, you're seeing a triple D coming right down to the 10-day moving average. That kind of looks logical to me. So, you know, watching the stock here. I think also another factor that might be contributing to the downside here would be SSYS, which bought up that small consumer printer, and it was up, but now it's down. Well, no, it's still up on the day. Why is this thing red? Oh, I see why. Because it gapped up, and it's lower than where it gapped up. My charts are color-coded that way. So, again, this one's kind of pulling into the 10-day. You know, if you got down to 83, 84, maybe that would become viable there. It's a possibility. So just, you know, this is kind of how I'm approaching the market. I'm not necessarily looking like you need to run for the hills here or try and be a pig on the short. You can, on the short side, you can make money shorting stocks, but I think you have to be cognizant of where they're coming in terms of undercutting logical lows and stuff like that, and taking your profits when the market hands them to you. And there have been some weak names that you could hit. So Vertex, that's a stock that I hate because, you know, you have these pocket pivots, and now it's basically violated the 10-day, but it doesn't follow the 10-day. Now you're just below the 50-day, so that's starting to look like trouble. But again, it's a market question, you know. So I guess you would say it's violating the 50-day, but in this market, it seems like violations of moving averages haven't done much good in terms of using those as your sell signals, because you see a lot of stocks turn. You know, here it's the SSYS violated this 50-day, and it turned. I remember we were talking about this yesterday on the on the chat room, and you know, when Amazon violated the 200-day, that should be the end of the world for it there, but nope. It turns around and goes higher. So, you know, a lot of times you see these moving average violations end up being lows for stocks. So I think you got to maybe try to be a little quicker. And you know, my approach is usually to just blow to cash or to back down and see how things pan out, rather than trying to be all in heavy. So, you know, I think that's really the way to handle it, and then selling into rallies when I've got a 10-20% profit in there. So, you know, so it's a little more proactive. I think in this market, if you could say, yeah, if you're looking at Vertex here and it closes below the 50-day, and the next day it moves below the intraday low of that low, then that's a sell signal. I mean, there is a risk of that faking you out, and that's happened in a number of cases. So I think you got to be very careful here. So somebody mentioned Splunk, and Splunk is holding up here. You can see it's holding along the 50-day moving average. Stock's just pulling back. I don't know, maybe it's just trying to build a base, you know, and it's going to set up in here and try to turn out of here. There's talk of other companies competing with them, but you know, we'll see where all that goes. Melee, you had a viable gap up here. It still hasn't violated the low of that viable gap up day, so you know, you couldn't necessarily say that that's the end of the world for it. It's just basing right now, it seems like, and coming right down to the 10-day moving average and the 50-day. Maybe it bounces off of there. So you got, I think a lot of these stocks you got to watch as they come down into these areas of support. FleetCor tried to come out as tight little area, and it's jacking down. But I think you're really looking at this as being your support area right in here, right at around what's the top of this high 60, or I'm sorry, 84.31. So I really think that's what you're looking at there. In terms of a pullback. Somebody asked, was Melee a pocket pivot yesterday? It's a little V-shaped. We didn't report on it because it was a little V-shaped, so I'm not really convinced that it is. So that's my take on it. PCYC, breaking down to the 50-day moving average, probably not a good sign. So I think that's something that, you know, like I said, the biotechs are pretty weak. Regeneron also getting its head handed to it. Couldn't get back above the 50-day, failed yesterday. So on that basis, if I had bought this pocket pivot, speaking for myself, I would have been out pretty quickly. On that basis, though, you know, you're undercutting this low, you're right on top of this area, maybe it tries to bounce. Maybe it needed to undercut that low to set up again. fundamentals are still pretty strong in the stock, but you know, it's a market question again. If the market keeps getting ugly, then they're going to tag these things and take them lower. Santaris is gapped down and is trying to hold the 50-day moving average, so that's about all going on there. RH is, and this is a Bible gap up, and it's still holding the Bible gap up day. So nothing, no rocket science here. You're just kind of watching how these things are and interpreting them in terms of the way that we look at stocks. And as they're pulling back, that's kind of what I'm watching here. These areas of support to see, where we go from here, and whether these stocks, as they pull in, are going to be able to hold these areas of support. So, kind of touch and go. Let's see, some of these, the solars, let's see what's going on here. You got, this one's the Solar City coming down, it's along the 10-day. I would say watch for a pocket pivot coming off the 10-day if the market turns. First Solar came out with a secondary offering. It's violating the 50-day moving average. It's not looking so hot, but notice it's undercutting this low here. So the possibility that it could do that and then turn out of here, but maybe it needs to build a new base. So you kind of want to keep an eye on that. Might still be viable. FBHS. One of the things about FBHS that I don't like, and it would also, we talked about, also count for lumber liquidators. We talked about the weakness in the housing stocks, and so I think as a leading group, they're fading, and that's pretty much it for them. So I think any of the stocks related to this group that have been leading stocks, you kind of have to shy away from at this point, and pretty much just avoid them. And so FBHS, for example, it had that. It had this pocket pivot, I think, somewhere in here, and then it backed down. It's trying to get going. Now you're back here. I don't really care for it. I don't think it's an area I want to be looking at. So let's see. I'm watching some of these things. Let's go back to our handy-dandy 620 chart. Some of these things, Apple trying to turn. Let's see what the Dow's trying to do. Whoops, lost that. Tesla's the one I keep an eye on here. Still nothing yet. Trying to find a low though in here. Let's look at the S&P. You notice it's trying to turn. You already had the MACD cross, so now it's trying to turn. So you want to keep an eye on that. Any others I should be looking at in terms of? See, most of these I think are pretty well under. Look at TDD. Let's look at this. This is pulled in. It's looking like it's trying to turn. So we'll see how that goes. Let's look at the UVXY. Now the UVXY just starting to break down here. See the MACD cross, and so if you're playing this as trying to hedge against the market coming down, just be cognizant of this. So this could mean that you're going to top here on the UVXY and you get a market rally and a push back to the upside, which is always a possibility here. It's just one thing we're keeping an eye on. Google. Google's just built a cup, a little mini cup, and now it's trying to build a little handle here. So it doesn't look like the end of the world. Uh-oh, what was that, Dr. K? You just hit an alert. I heard that.
Yeah, that would a little bit of gunplay here.
Someone comments, for a central banker that's trying to hold up the markets, Ben sure says the wrong things. Yeah, I actually thought it sounded like he was just saying, oh, we're going to continue to flood the markets with liquidity, and we don't see that ending anytime soon, and we have a plan for it. But you know what? My thinking is they're not going to be able to implement their plan because the economy is going to remain weak, and you're not going to see some strong economic growth, and it's just going to continue. They're going to have to continue to play this QE game. And I think the U.S. ends up very much like Japan for 20 years. What do you think, Dr. K, where you're in QE land for several decades, and that could be another scenario where we plunk along like that for a long time unless we find a way to generate real economic growth. And like I was pointing out earlier, it could be the oil sector is something that drives growth.
Yeah, I think that we could be in for a stagflationary environment that is creepingly higher inflation and a very slow, stagnant economy. And we know that stagflation persisted in the 70s for a number of years. I wouldn't be surprised to see that kind of scenario set up, barring any sort of strong catalyst like the energy market. The energy is something everyone needs, and maybe some of our listeners know this, but back in the early 70s, the UK economy was pretty much finished. And somehow, well, they managed to stumble upon the North Sea oil supply, which is, hundreds of billions of barrels of oil. And as Jimmy Rogers likes to say, you show me that much oil, I'll show you a good time too. And so the UK economy was rescued and managed itself quite well over the last 40 years as a result of that. But there's speculation now that the North Sea oil supply for the UK is going to be drying up by 2018. So, unless they have some sort of other energy trick in their back pocket, the UK and places like London could also fall under some pressure.
Yeah. So let's see. TBT is up today. That's inverse bonds. So that means bonds are breaking down. Is this ETF a way to play the interest rate gyrations? I don't know. What's your take, Dr. K? I don't really play this one. But to me, it just tells you bonds are going down the toilet, and that's about it. So,
right. I mean, you could play the trend. If you want to play, trends work in any market, whether you're in the futures markets or the stock market. So, if you want to play this trend, the odds, it's an odds game, and as long as you stay with the trend, then you might do very well over a period of months, since bonds, the price of bonds is probably going to go lower given the fundamental tone of everything, and so interest rates are probably going to be heading higher. I mean, I guess the idea is how much lower can they go? And I remember in the this is in 1980, that era where you had a huge spike in interest rates, and the 30-year was something like 18%, some crazy numbers. And so, as they said back then, that was a no-brainer because interest rates really couldn't go up much higher than that. And so there were guys who stepped in. Some of these big funds would step in, and big investors would step in and just start buying bonds because the price of bonds had to go up because the interest rates had to come down. So I think we're on the flip side of that right now. So if you're long-term, if you have a very long-term perspective, you could probably play something like the TLT, or you could play the idea that the price of bonds is going to go down, the yield's going to go up, and sit on your position for a number of years and see what happens. But that, again, this is much more of like a Jimmy Rogers type of fundamental play where he'll buy a position and he'll sit on it for a number of years, and usually he comes out ahead.
What was the quote from Jimmy Rogers you said earlier about show me that much oil and I'll show you a good time?
Yeah, show me hundreds of billions of barrels of oil and I'll show you a good time too.
I love it. Classic Jimmy. Somebody's saying VRX 620 starting to come back, but market not good. No, market sucks. So, I mean, that's kind of obvious to me at this point. But VRX, well, I mean, you're not really seeing a cross. Talk to me when you see a cross in here, but it's possible that it tries to make a turn in here. I think you just kind of keep an eye on things here and see how this pans out. This could turn out to be a nice short-term buying opportunity, and then you get another jack to the upside, and you can trade some of these stocks. I mean, that's what I've been doing all year long for the most part, with my own money, and it's worked. And it's an unorthodox way to play the market. It's not like we would normally do it when things are trending, but I can't argue with something that's worked, and it seems like that's the way you needed to approach this market, at least from my perspective. Anyways, it's 8:50. We need some more questions, otherwise this is going to be a pretty short webinar. But again, there's not much to say. I think you just got to look at where we are in the indexes. So number one, with the NASDAQ coming down to the 50-day moving average, you got to watch for a bounce here. And this could get everybody, everybody wants to get short and bearish here, and it does create a weird bounce. And in this market, it's not something that would really surprise me. So I think that's something you got to keep an eye on here. Here we have someone who, in light of, is it a better idea to stay in cash rather than buy some of the recent pocket pivots that have pulled back in light of the markets today? Well, you're asking us to tell you whether you should be buying right now, and I guess if you wanted to test some of these here and keep a stop on them, I guess, and see where they go, maybe you could. But I think we're waiting to see how this market reacts. If you get a turn in the market, then you maybe have an opportunity to come in and buy some of these stocks as they're pulling in, and really that's been a profitable way to operate in this environment. And so I think it's just a matter of waiting and watching. But I can't sit here and say, oh yeah, you should buy this, and oh yeah, you should buy that. So it depends on where you're at in terms of your overall positions and whether you're up or down for the year, I suppose. Let's see. Somebody wants to know what is the best of all the 3D printer stocks. Which has the best story and chart combo? I don't really get into stories so much. I think I'm looking at the earnings on most of them, and they look decent. So I think they're all viable. So 3D is viable. It's just building a base. You're coming down to the 10-day right now on the weekly. Yeah, I'm doing this again. What chart is this? I've done this again. I keep doing this. I keep pulling up charts on my NASDAQ chart. Get this out of the way. Stay over there. Okay, now we're good. So let's try and evaluate these. I just look at how they're acting. It's trying to build a base right now. So if it bounces off the 10-week, then that's probably a good sign. Stratasys tried to break out and failed, and now it's bouncing up. So this X1 is an insane stock and has these huge V-shaped moves, but it seems to be able to hang in there. So I'm watching some stocks starting to come back a little bit now. Who knows? Maybe the market's going to turn off of here and end up on the day. It sure as hell would not surprise me. Somebody, if you just got onto the call, it's really hard for us to go back and answer everything that we've already talked about. You're going to have to look at the video. So we don't conduct these in reverse. So I just want to point that out. But so I'm going to go ahead and throw this question out at you, Dr. K. And the last but not least, Proto Labs, is probably the leader, I guess, right now in the whole space because it is broken out and it's trying to hold up on the pullback. So, maybe that's your leader. But to me, they're all viable. Just show me a buy point. Show me a pocket pivot or show me a constructive pullback to a 50-day moving average, etc. And I would just go on that basis. It's not rocket science. You don't need to overthink it. If you're looking at 4 or 5 stocks in the 3D printing space, well, which one shows me a buy point first? Which one shows nice support at a moving average that maybe I want to buy into the pullback? Stuff like that. It's pretty simple, and if you overthink it, as long as you have a reasonably good story, and I think 3D printing really is in its infancy, so the thing that's going to tell you whether it's viable longer term is going to be the action of the stocks. Dr. K, here's a question for you. Are you ready?
I am.
Okay, I noticed you're not dropping out today. It must be that new router.
It was the router, definitely. That router is really getting. I guess it taken a good licking. So I think those bad days are in the past.
Right. Okay. Well, it took a licking and it did not keep on ticking. All right. I like that. Okay. UVXY. Someone's asking, what is the chance of upgrade from beta on UVXY 9 months in from last tweak? Huh?
Basically, the model's more or less ready to go. It's just like it's been in this final beta phase for a while, just because also the markets this year have been quite different with the very anemic uptrend in the first quarter, and then the model is on the verge of going full on, but the market really hasn't been been acting in a normal way, and so the model is still a bit tenuous in terms of releasing itself from this final beta phase. So when it happens, it'll happen, and it'll probably happen when the markets start to return to some form of normalcy. I mean, this year, 2012 was absolutely a very difficult year for most all trend followers out there, including the trend following wizards. In fact, I think it was their worst year as an aggregate group, with many of them down double digits. And then this year has been, it's been a market of a different sort in the final stages of QE. So let's see what happens.
Here's this question. Actually, I'm going to call this one the question of the day because I'm not really sure what it means. But Dr. K, are most of your long positions staying above porosity levels?
When you're talking about things like viable gap ups and such, I haven't been playing too many of the long side. When I do, I keep the porosity level typically between 1% to 2%. And in a year like 2012 and this current year, a lot of the leaders haven't really made much progress, and they will sometimes get, I will get stopped out. But I definitely keep to my sell rules simply because you have to. Sell rules are risk management's rule number one, as Ed Seykota always said. And then you've got your pattern recognition and your trend following. Those are rules 2 and 3. And that's his 3 rules in terms of how he trades the futures. And I would say that they certainly should apply to anyone who trades the markets.
So the answer then is that you don't have any positions to remain above porosity levels then.
Yeah, no, I'm in right now. I'm in cash, and sorry, well, cash is concerns stocks. I don't have any stocks. I do have ETFs, however, because of the model.
Okay. What is physical gold stock as solid as real gold bullion under the bed? What is this? Well, obviously, it's just gold. I don't know. I wouldn't want to own paper gold. And as far as I'm concerned, if you own a piece of paper that says you own some gold somewhere, that would be paper gold. So I don't think so. Do you think the U.S.'s possibility of oil independence might be a possible reason why there is more unrest in the Middle East, Dr. K?
Sorry, say it again?
Do you think the U.S.'s possibility of oil independence might be a possible reason why there is more unrest in the Middle East?
I don't like to speculate on stuff like that. Again, a lot of these things are cross currents, so that's not going to help me as a trader really to get wound up into understanding, all these possible cross currents. I mean, it's just too much information. If I need to focus on something like that, then I will. But until I need to focus on it, I'm not going to worry about it. I just focus on the price volume.
Right, and I don't understand how intuitively, why would the U.S. approaching oil independence cause unrest in the Middle East? It seems to me it's more a function of some pretty lame policies by the Obama administration in terms of embracing the Arab Spring without really understanding the implications. For example, helping in Libya, helping them to overthrow Gaddafi. Gaddafi wasn't really a nice guy, but he did lay down his weapons of mass destruction when Bush, after we attacked and took over Iraq, and Obama encouraged that to occur. And what do we have? You have Benghazi, and now the CIA reports that Al Qaeda now has, I guess, their SA-7 missiles. Their surface-to-air missiles. They were able to acquire those from Gaddafi's arsenal that he had previously kept under control, and so that's what's caused. The unrest is caused by the fact that you have policies that are encouraging it, but from the Obama administration, but also it's been an area that's been oppressed, and you've had corrupt leadership there for decades. So that's what's driving it. I don't think it has anything to do with the U.S. oil independence. I think it is a good thing, though, over time that the U.S. Is less dependent on that region, because then we can just ignore it for the most part. So let's go through some more names before we shut it down today, because I want to watch this market and see where it goes. Coors, it's a big, ugly pattern here. Maybe it's breaking down. You're not seeing heavy volume on the downside today. So for all we know, this thing's going to turn around and bounce off the 10-day. But I can't tell anything here. So, and I'm not in here trying to aggressively short the market. I'm more looking at the possibility of coming in on a bounce. We'll see what happens. I mean, it doesn't have to pan out, but that's kind of how I'm looking at this right now. So, just kind of waiting and watching. Somebody says, Gil, check the consciousness level of the Middle East, and all questions will be answered. You got that right, Bob. Anyways. I think that's all we have. So, but like I said, watch this market and see if these things coming down to support, they don't turn. It wouldn't surprise me, and I want to be opportunistic that way, rather than trying to be reactive and freaking out here. So, but again, like I said, when I'm short and I see the index is coming down to an area, here we go, bringing up this again, an area where they could bounce. I'm very cautious and looking for areas to cover, and that's the reason why I covered my Apple this morning, because you had undercutted this low. It's still kind of hovering here, so I guess if the market broke down, it might go lower. But what I'm looking for here is to get a reaction rally back up to the 50-day with the market. But I would keep Apple. Would it surprise you if Apple makes a punch bowl of death? I guess what you mean if it came all the way up. No, that wouldn't surprise me either. I mean, anything's a possibility. So I think you just kind of have to watch the action and kind of go with it. Not get too wrapped up in your head. in terms of trying to overthink things. You know, as long as this can't get back above the 50-day moving average, I think it's in trouble. But if it was able to forcefully get back above the 50-day, I would be using that as my upside stop if I'm short the stock, at least my ultimate upside stop. But for the most part, you undercut this low, and I'm going to take short-term profits. End of story. So that's really my approach there. So, anyways, watching the market try to connect. Let's take a last look at a 620 chart on the market. Here's your VRX fans. Watching Tesla too, you might notice is trying to turn off the lows. I still think it's a strong story, and that's one of my favorite stocks. If this market turns, I want to be heavy there. So yeah, maybe I'm crazy, but that's just me. SPX is making a 620 turn. So, you know, a lot of times if I see this and I'm heavy short, if I haven't already covered on the basis of a 620 turn in my short position. So let's take a look. I mean, what's coming down today? CF is coming down pretty good. You see, if I've been short CF from yesterday, say, the turn here I'd be covering and taking my profits and then just backing away and seeing where things go from here. That's basically what I would be doing. So that's how I'd handle it, because the other thing is this is coinciding with the NASDAQ at an area of support, and I think if you didn't look at the S&P 500, which you're looking at the S&P, it's testing this low. You know, maybe it undercuts it and goes a little bit lower, but you know, right now you're starting to see some support come in, and maybe this is where they got the shorts all trapped and they're going to turn the thing. So, anyways, just I'm going to explain this for you, Scott, and this is the last time. Scott spends a lot of time on the chat room, but yes, this orange line is a 6-period exponential. You can see this little orange thing up here. Let's see if I can get it out of the way. MA6 based on the close. E is for exponential. I actually use a 20-period simple. So, you know, you can use this. That's just the way I mixed it up. So, and that seems to work. And then the MACD is 6, 20, 10, and C. So that's how you would set that puppy up. And that's basically it, you know. I'm noticing Triple D. Whoops. I keep... you know, this is trying to turn. So you got a number of things trying to turn here. Keep an eye on Tessie, as I call Tesla. But anyways, but you know, the 620 thing. This there are people in the chat room. They've mixed it up and they use different combos, and I think you can go mess with different combos, and just kind of tweak it that way. You know, it's not rocket science. So, and it's not some magic thing. You know, people. I brought this up in the chat room. People are starting asking, what are your rules for 620 stocks? And it's like, you know, the fewer rules, the better. I'm just watching the way this thing acts, and I use it as a guide. So what are you seeing right now? You're seeing everything starting to turn. So if you're short, be careful. And if you're looking to buy some stocks, you see something at support, maybe you can nibble here, and you'll be okay. So, you know, touch and go, baby. Anyways, that's all I got. You got anything else, Dr. K, or is that it? Are we done for today?
I think we're good.
All right. Anyways, everyone, good luck today. We'll see how this ends up. But, you know, crazy market, crazy times, but still fascinating nevertheless. All right, take care.
So long, everyone.